This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in addition to the normal work following a lecture of going back through everything you had to do in that lecture, I also asked you to read ahead in readiness for this one. It's only 2 basic sections and hopefully it didn't give you too much trouble. Certainly not this one anyway, the section on gains and losses. So what happens therefore in terms of corporate tax and chargeable gains? Well, there's the first point. Capital gains are of course chargeable to corporation tax. Now of course in any accounting period for which we prepare the corporate tax computation, there may be more than one disposal. And those disposals don't necessarily always give rise to gains. There may also be losses. So what do? Capital losses only arise when net proceeds are less than allowable cost. Indexation allowance may not be used to either create or increase the loss. Yep, in computing a chargeable gain, the new bit in terms of corporate tax was the availability of indexation allowance, not available of course to individuals. But that indexation allowance, the best it could do was to reduce an unindexed gain down to 0. It couldn't turn a gain into a loss, and equally it couldn't create a bigger loss. So it simply was a capital loss based on the fact that the net proceeds were lower than your overall total allowable costs. If we've got gains and losses, if gains and losses arise in the same accounting period, they are netted off. No choice about that. We must net off gains and losses of the accounting period. If the resultant figure is a gain, as we started with up here, it's charged to corporate tax and it appears on the corporate tax computation as we saw back in chapter 16. If, however, the resultant figure is a loss, we dealt with various types of corporate tax losses in chapter 18. It is carried forward and set against future gains. Capital losses may only be relieved against gains, not income. So there's only one thing you can do with a net capital loss for an accounting period, and that's to carry it forward to set off against future net gains of a future accounting period. It does not go against income. Also, in terms of terminology as to interpret a question, don't confuse here. The terms capital gains and chargeable gains are interchangeable. So if we talk about capital gains or chargeable gains, they mean one and the same thing. Having dealt with the general introduction of how we go about computing gains for companies and how we then deal with the gains and the losses that we have established, we have to look at now specific scenarios. The first of which is commonly tested, is the disposal of shares. Now, you will probably look back at the disposal of shares in relation to individuals. And what we saw, as we have mentioned before in our first session on corporate tax and gains, what we know is that the problem when you sell shares, some shares out of a shareholding, a bigger shareholding held within that particular company, that although you clearly know how much you are selling them for and what selling expenses you incur, all of that will be given within the exam question. What we then need to find is the allowable cost, and therein lies the problem. It would be fine if you'd only ever bought one lot of shares at a given cost figure in that company. But what we will have is several acquisitions spread over a number of years, and therefore, because those acquisitions were at different cost figures, we need to have share identification rules that will tell us when some shares out of a shareholding in another company are sold, which shares are deemed to be sold first. Now, we know the rules that we had for individuals, and as we said at the very beginning of our look at gains for companies, it wouldn't be taxed without another silly rule, and that is that we have a different rule for identifying the order of disposals in terms of corporate shareholdings. Let's introduce ourselves to this though. Disposal of shares give rise to chargeable gain or allowable loss. Again, shares are chargeable assets. Difficult, however, to identify which shares are being sold and therefore establish the cost of those shares sold, where it is only some of the shareholding, this is in a particular company, being sold, and the shares have been acquired over a period of time and of course importantly at different costs. So what do we have to do? We need rules by which we can identify the shares sold by using the matching rules. We don't get to decide which shares we will deem to have sold. It is HMRC that lay down those rules. And they're not exactly the same as the matching rules that we use when dealing with shares with the same problem for individuals, disposing of shares we saw back in chapter 13. Now, again, there's a reason why we have different rules for companies than we do for individuals. It's not just let's make life difficult for tax students here taking their professional exams. There was a reason. The reason being, not that you won't be tested on this, but just so that you understand the idea, gives you a background to this at least. That is, individuals get annual exempt amount and companies don't. With individuals, what they could do before they change the rules to give us what you know as the rules now for the identification of shares, where we now have, for individuals, shares acquired on the same day and then shares acquired in the following 30 days. Odd that we're identifying a disposal today that if there was another acquisition today, that would be an immediate match. But if there isn't, then we recognise what we sell today with shares in that company that we buy in the following 30 days there, before then going back in time to look at the share pool. Now, why did they do that? The reason being that before they brought that, as it was then a new rule in, where we only looked same day and then back to previous acquisitions, what would happen is we would be able to sell some shares in a company at the end of one day and buy them back again at the beginning of the next day. You might think, well, why did you sell them, or some of them, if you then go and buy them back the next day? Why would you be doing that? The reason for individuals is we have AEAs, currently, £12,300 for a tax year. And as with personal allowances, you use it or you lose it. If I don't use my AEA for this tax year, I don't get any of that lost AEA this year available next year. Each year has its own AEA, use it or lose it. So what would happen with shares, very especially quoted shares, which have a ready-made market on the various share exchanges there, then if I had what I thought was a good investment, and I could see that I could hold that for years, and the value of those shares will go up by tens, if not hundreds of thousands of pounds, it would be silly to buy those shares now, then sell them in 5 years' time or 6 years' time for a gain of £50,000 or £60,000. What I could do instead is, next year, if gains have arisen, I could sell them off, crystallise a gain of, say, £10,000, £11,000, £12,000. That gain is covered by my AEA. It is not taxable, and it won't be taxable in the future. It's covered by the AEA. I buy them back again, and that rebases the cost to the current higher level. So each year, through 5 or 6 years, again, it's simplistic and I'm assuming that share values increase on a sort of rational and straight line basis here, which doesn't always happen. But if I could make over 5 or 6 years gains of £10,000 to £12,000 in each year on those self-same shares, sell them off at the end of one day, buy them back at the beginning of the next day. Why overnight? Well, we always recognise shares acquired and sold on the same day, so we had to wait until the next day. Overnight shouldn't really be, unless something horrendous happens, any huge great change in price. So apart from a few administration costs there, in terms of the sale and the purchase, I'm basically able to sell them back at buy them back at about the same price. So I could rebase my costs to current values. So I, over 5 years, could make 5 lots of gains of £12,000, £60,000 in total over that 5-year period, and none of those gains would be taxable because each would use up an otherwise wasted AEA. If I'd simply kept hold of them and sold them all in one go 5 years later and made a £60,000 gain, I'd have one AEA, and then the rest of it, nearly £50,000, would be taxable and probably at higher rates there. So that practice was known as, lovely term here, you'll love this one, bed and breakfasting. Bed, sell at the end of one day, breakfast, buy them back at the beginning of the next day. So that's why they introduced the rules for individuals. Shares acquired in the following 30 days would be the ones you match with after having checked for purchases and sales on the same day. And you do that before ever going back to the share pool. It means that it stopped bed and breakfasting. You couldn't then sell on one day and buy them back the next day. If you did, then as we know with those rules, you just match the sale with the purchase of the following day. You wouldn't get what you'd hope to get, a rebasing in your costs. Now, of course, you could still do it as an individual. It's just that you have to stay in bed for 30 days. And over that 30-day period, who knows what's going to happen in terms of the value. It could, of course, go way up, and that means you've lost all of that increase in value because you didn't own the shares at that point in time. So the rules for individuals was to stop the bed and breakfasting practice where individuals could sell off sufficient shares to use up their AEA and carry on doing that year after year after year. Companies don't get AEA. Companies, therefore, never had the facility to buy, sell on one day and buy on the next day and use an AEA. They don't get one. So there was no need to have that strange rule of recognising a share sale with acquisitions in the following 30 days. We do, however, have these rules here where it's the same as individuals to begin with, shares acquired on the same day. There is also, if I go to the third and final recognition identification rule, shares contained within the share pool, like we do with individuals, but the one in between is shares acquired in the previous 9 days. So instead of looking to the following 30 days, as we did for individuals, a much more sensible rule, shares acquired in the previous 9 days. Those would match. Obviously, something acquired in the previous 9 days there is likely to have a cost somewhat akin to what the current sales proceeds are. But whatever the logic behind it, don't worry. These are the rules that you need to learn. Important also, if you're going to get this as you may in a Section A objective testing question, which is something we discussed about answering capital gains questions in particular in terms of objective testing questions. You've got to be so careful to read the information. Now, it's an obvious statement for any exam. But the first thing you do in terms of a capital gains question is see who is disposing of what. Who is either an individual, so you know it's CGT, or here it's a company, so you know it's corporate tax and the differing capital gains rules that will apply in corporate tax. So job one, who is disposing of what? Is it an individual? Is it a company? Then what are we disposing of, and are there specific rules like there are here in terms of dealing with the disposals of shares? So these rules, we sell some shares, easy for me, so we sell some shares. We sell some shares today. Did we buy any also today? Whether before or after the sale, doesn't matter, it's the same day. It's probably not going to happen in an exam question. What you may have on a corporate disposal is, however, shares acquired in the previous 9 days. Now there's a specific allocation. Those shares sold today, firstly, the shares acquired in the previous 9 days, how many of them were there, what was the cost? If they've all been sold, put that cost against those proceeds, and there is your gain or loss that has arisen. But once they have gone, which they will have done in an exam question, it is always the share pool that's the major object of testing in terms of an exam question here. Now, you know what a share pool is in relation to an individual. We would record each transaction in chronological order, be that an acquisition, but ultimately a disposal. And so far as the share pool was concerned, we would keep the information going in the form of how many shares had been acquired or now were being sold, and in terms of acquisitions, what cost of those shares had been incurred. So we had two columns, a number of shares column and a cost column. And it'll be the same to begin with for companies. We will also record for acquisitions and disposals the number of shares bought or sold and the cost of those shares bought, and we will use the share pool to establish the cost of the shares now being sold. That was the purpose of this exercise. When some shares are sold, what is the allowable cost? That figure here comes from the share pool. But with companies, unlike with individuals, companies also get indexation allowance. So they have the ability to reduce their capital gain by the deduction of an indexation allowance. So what happens in terms of corporate tax and the share pool is that we have an extra column. That's all it is. We have an extra column to include within the share pool. As we've already said, you will record the number of shares bought and sold. We will need to know the cost of those shares. Well, that's obvious in terms of the acquisition. What did we pay for them? And then the problem issue, but it's a pool, so we work on a proportionate basis. If we sold off half of the shares within the share pool, half of the total of that cost column would now be deemed to be the cost of the shares being sold. We just work on a proportion. It's a pool basis. But what we've also now got for corporate disposals is an index cost column. And that's the only new thing. And indexation, as you know, is a very simple process. You are given an indexation factor. You don't have to work it out. You're given an indexation factor between two dates. What that has been so far is when did you buy, when did you sell, when did you buy, and to December 17, because we will be seeing disposals, of course, in accounting periods ending in 2020 or 2021. So we know to apply the indexation factor to the allowable cost there, and that will be stopped, frozen at December 17. What we do with shares is to keep a running total of index cost going. Every time we buy, every time we sell shares, up at least until December 17, then we bring that cost, that as it will be index cost column, up to date in terms of, we call it re-indexation. For any inflation that has taken place, you're given the indexation factor from when the last re-indexation took place to the current date, be that another purchase or be it indeed the eventual disposal. But knowing that such indexation, or re-indexation as we call it here, does not extend beyond December 2017. Now, the only way to deal with this, of course, is with an example, but just so you can see the note on this, the share pool records the number and the cost of shares for each acquisition and disposal. That's its purpose, that on a disposal, we can establish the cost of the shares being sold. So that's as it was for individuals. But we've also got to deal with the fact that companies are entitled to indexation allowance. Thus, whenever shares are purchased or sold, a re-indexation of the index cost of the shares in the pool is added to the index cost total, which is recorded in a separate index cost column of the share pool, as we've seen here: number of shares, cost of shares, and index cost. Index cost will record both the cost, exactly the same as in the cost column, but plus then to any future sale or purchase, we do a re-indexation. date to date, with the last of those dates being December 17 there. And we do that re-indexation, as we'll show in an example in a moment. As we've just said, indexation factors will be given, and indexation allowance is frozen at December 17. So we've got example 2 here to follow through to illustrate how these rules work. Now, with any question, what do? We calculate the gain arising on the disposal in December 2021. So we've got a gain arising on a sale in December 2021. We're also given various indexation factors. What we've now got to look at is what shares were sold at what date, and then match them with the relevant acquisitions, applying our rules. Were there any shares acquired on the same day as the disposal date? Were there any then shares acquired in the previous 9 days? If there were, then we specifically take those shares acquired in the previous 9 days, and they are the first deemed to have been sold. If, as is likely, all of them will have been sold, then we know the total cost, we know how many shares were acquired, what is the sales proceeds on those shares, and put the cost against the proceeds to give you gain or loss. Before then we move back to the shares in the share pool that demands that we construct that share pool. So let's have a look at the dates and analyse which of those rules, identification rules, will be relevant here. We're told that A Limited had bought the following shares in B Limited. So we then get a history of buy. But then we've got A Limited sold 3,000 shares on the 10th of December 21 for £36,000. So there's the sale, and we need to know which of the shares bought over the previous acquisition dates, which ones are being sold, so we can match cost against the proceeds of those shares. So what have we got here? Were there any shares acquired on the same day? Well, the original acquisition was back in August 89, followed by November 96, nowhere near the 10th of December 2021 there. So all of those first two, are bound to go into the share pool. And we'll look at the construction of that in a moment's time. But then we've got this one, the 7th of December 21. Yeah, 7th of December 21. The sale was the 10th of December 21. So we do have an acquisition within the previous 9 days. Now then, how many shares are being sold? 3,000 shares. What do we buy in the previous 9 days? 500. So all 500 shares that we had acquired, the company had acquired on the 7th of December 21, will be deemed to have been sold on the 10th of December. And they're the first ones that we recognise. We know the cost of those 500 shares, and we can put that against the sales proceeds on those 500 shares. That'll be a quick use of the calculator for you. There were 3,000 sold for 36,000. So what would have been the proceeds of 500 of those 3,000 shares? That will give you a specific and first calculation of a gain. We'll do that together in a moment's time. But that will have accounted for 500 of the 3,000 shares. So that means that a further 2,500 shares must have come from the share pool. A share pool that contains 1,000 plus 2,000, 3,000 shares. So, we now know that to work the gains arising in relation to the disposal of these shares on the 10th of December 21, we will firstly identify the shares bought on the 7th of December 21, those 500 shares at a cost of 5,000, get the sales proceeds for those 500 shares, compute an individual gain or loss. That leaves a further 2,500 shares to come from the share pool. We will therefore have to construct that share pool accordingly. That we'll do together in a moment's time. What I'd like you to do, first of all, is to work out what gain or loss arises on those shares now sold that have been acquired in the previous 9 days. You know the cost figure is £5,000, so all you've got to do is to work out if 3,000 shares were sold for £36,000, what was the proceeds of 500 of those shares? So if you could do that for me, please, and then together we'll work the share pool. So applying our share identification rules, therefore, we know that the first 500 out of the 3,000 shares sold on the 10th of December 2021 were those acquired within the previous 9 days, to be precise, on the 7th of December 2021. We know that they cost £5,000. We therefore will deduct that cost from these proceeds. The 3,000 were sold for £36,000, so 500 of those 3,000 shares sold would, if my arithmetic is correct, have given us a £6,000 figure of sales proceeds, hopefully the figure that you've got there. Again, you could have divided the 36,000 by 3,000 to get a price per share and multiplied out by 500, but you would get, I hope, proceeds of 6,000, meaning that on these shares we have a gain of £1,000. So the first 500 of the 3,000 shares sold, we've now dealt with. We know on those shares, those that were acquired within the previous 9 days, we've made a gain of £1,000. But that still leaves 2,500 shares that come from the share pool. If we go back to the question, we've already identified which shares will go into that share pool. Anything bought prior to the previous 9 days. And those were these shares bought originally on August 89 and then November 96. So we now set up a share pool. Now there's 3 bits of information we need to record for initially any acquisition, or as it is here, acquisitions, and then eventually a disposal. We need, on the right-hand side of our page, a column for the number of shares, for the cost of those shares, and then the new column as compared to what we run in a share pool for individuals, an index cost column. And we go back to that first original acquisition. So there it is, 20th of August 89, 1,000 shares, cost £5,000. Now again, when you're doing all of this in an objective testing question, you're not bothered, therefore, about your presentation because no one's going to see it. It's simply down to you to get the right answer as quickly as you can. But I'll show you here how we would show this, how we would present it, if it was to appear within a Section C question, which is incredibly unlikely, to be fair. So we've got 20th of August 89, 1,000 shares, £5,000. So 20th of August 89, was it? It's an acquisition, and I think it was 1,000 shares at a cost of £5,000. Let me just check. 20th of August 89, 1,000 shares, cost £5,000, and that £5,000 cost is recorded not only in the cost column, but anything that goes in the cost column will also go in the index cost column, £5,000. So that initially set up this share pool based on that original acquisition in August 89. Now, these acquisitions and disposals are known as operative events. A purchase or a disposal are known as operative events there, a term that we'll use as we go through our studies of this particular subject. So the first operative event, the original acquisition of 1,000 shares at a cost of £5,000. We then need to move through to the next, and indeed the only other acquisition that has gone into the share pool. That was this 16th of November 96, 2,000 shares at a cost of £12,000. So we'll be needing to record that acquisition, but before we record that acquisition, before we do that, we will be re-indexing our index cost figure. Now, the date of this transaction, we have the 16th of November 96. So, 16th of November 96. First thing we do is to re-index. We need to bring that index cost column up to date for the effects of inflation. So, we're going from August 89 to November 96. So there must be a given indexation factor that has those dates. And there we go, August 89 through to November 96. August 89 to November 96 there. And that figure is 0.329. So re-indexation 0.329 there, times what is in that index cost column, £5,000. And you will then record that in that index cost column. We will then deal with the acquisition. The acquisition on that date was, I think, 2,000 shares with a cost of 12,000, and anything that goes in the cost column will also go in the index cost column. Which means then at that date you would be able to record that at November 96, following this purchase, there were now 3,000 shares in that share pool, and they had cost £17,000. All you need to then do is to compute what that index cost figure will be. So I'll leave you, therefore, to just get your calculators out and do that calculation. Place that re-indexation figure into your index cost column, add it in with your existing costs of shares bought of 17,000 to get your index cost at that date. So I'll just pause here while you do that, and I'm sure you'll be back in just a matter of seconds. Okay, so let's return therefore to our share pool working, and all we had to do was to establish the re-indexation from the date of the original acquisition to the second acquisition, so there from August 89 through to November 96. That re-indexation factor given to you, as they always will be in the exam question, 0.329 times 5,000 is hopefully that number there, 1,645. So our index cost total in November 96 would have been, well, we're adding 1,645 to 17,000, so £18,645. So every time we buy new shares, first thing you do, you re-index the index cost total from the previous acquisition, or indeed the first acquisition, if it, as was the case here. We re-index that to the next acquisition, the next operative event date. Then we add in the extent of the purchase, how many shares, what cost, and anything that goes to the cost column also goes to the index cost column. Once we have done that, we've now reset the index cost column total at that date. We move on to the next relevant date. Now that next relevant date could be if there was another purchase before December 2017, then it would go in with re-indexing to that date and then put in the acquisition and revise your cost and index cost columns. If, of course, there are no other acquisitions, and the next acquisition may be post-December 17, or the disposal, as it is here, is post-December 17, then the last date for re-indexation is that we re-index to December 2017. That's the last re-indexation that will take place. So if we go back to the question, we are given indexation factors. We've already indexed up to November 96. So we now go from November 96 all the way through to December 17. And that indexation factor is 0.82. So back to our working of the share pool, we would have 0.82. Now, again, we go to 3 decimal places. They might say 0.820, therefore, but we only go to 3 decimal places. In fact, in real life, we don't do that. So one occasion where we don't. But for us, in terms of our examinations, they never expect us to use retail price indices to establish indexation factors. They give them to us. So we take what is given. There it is, 0.82 times. What is the current balance on the index cost column? £18,645. You work that out, you put it in, and you've got your revised index cost. So you would know at December 17, there are still 3,000 shares that still have a cost of 17,000, but the index cost of those will now be significantly greater. So that's the next thing for you to do. And once we've done that, we'll then be able to move on to, well, what started all of this process, the disposal at the disposal date of the 10th of December 2021. But can you establish there for me, please, very quickly, what that new revised re-indexation figure is and what the newly revised index cost will be at that date, December 17. Okay, so hopefully no calculator problems there. Our re-indexation on our index cost total of 18,645 as it was in November 96, 0.82 times that 18,645, all being well, £15,289. That's an uplift in terms of its index cost, serving of course to create a much reduced chargeable gain as a result of the available indexation allowance. That has revised the total on this index cost column to 33,934, and it is of course the last date at which any re-indexation will take place. Indexation allowance stopped, it was frozen at December 2017. So that's the last re-indexation you're ever going to have to do. If we bought more shares after that, we just throw in those shares, number of shares, cost of shares, and put the same cost into the index cost column. There'd be no more re-indexing to do, only up to a final date of December 2017. But what is next is not an acquisition, but again, the other form of operative event we may see, which of course is a disposal, which was, as we said, the object of the exercise. Now we know that on the 10th of December 21, we sold 3,000 shares. That's what we started with. But 500 of those shares were deemed to be those acquired within the previous 9 days. So the number of shares now coming out of this share pool that contains some 3,000 shares will be 2,500 of those shares. And the purpose of this share pool is that in order to compute a chargeable gain, we'll need, of course, to get the sales proceeds on the remaining 2,500 of the 3,000 shares sold, but then is to get the cost, which we'll get from the cost column, and then an indexation allowance, which, if we look at the figure in the index cost column and the figure in the cost column, what's the difference between index cost and cost? It's indexation allowance. So how do we do that? We are now selling, as we have said, 2,500 shares out of 3,000 shares. Those 3,000 shares have a cost of £17,000. When you've worked that figure out, it will go in there. You will then do exactly the same calculation. We're selling 2,500 out of 3,000 shares in terms of the index cost, 33,934. And that figure will go in there. In reality then, you would update your total. You'd now have 500 shares with whatever balance of cost and index cost remained. Again, we are only interested in one thing, and that is in answering the exam question, which has presumably asked you to calculate the total chargeable gain arising on the disposal made on the 10th of December 21 of those 3,000 shares. We already know that the first 500 shares gave rise to a gain of £1,000. The remaining 2,500 shares, that gain we now need. This is the purpose of the share pool, because against the sales proceeds of those 2,500 shares, you will be able to take now the figure of cost from that column and the figure of indexation allowance as the difference between your index cost figure and your cost figure. Now then, that is how you would lay this out, and I'll show you that in a moment's time, if you were doing a written answer. If it's an objective testing question and all you need is the chargeable gain, then quite simply you would deduct that index cost figure from your sales proceeds. That is fine as long as the index cost figure is lower than those sales proceeds, so a chargeable gain arises. What we know, however, is that indexation allowance cannot serve to create or increase a loss. And that's the reason why you are supposed to split the calculation of the gain into two. Firstly, deducting the cost figure to give an unindexed gain, and then to deduct indexation allowance, the difference between these two figures, as we'll see in a moment's time. Because the indexation, all it can do is to reduce an unindexed gain down to zero. Now, if it is very obvious that your proceeds figure is bigger than your index cost figure, and it's an objective testing question, don't mess around with two calculations. Just take your index cost from your net proceeds and get your chargeable gain job done. Again, we'll show that in a moment. But I need you, therefore, to get these apportionments done, to get your figure of allowable cost to go in there, then to do the same exercise on the index cost to go in there. And once you've got those numbers, then we can do our gains calculation. Okay, if not already, if you do that for me now, please, and then rejoin me and we'll look at the final part of the answer. Okay, now looking at the model answer in the back, and by all means turn to that as well at this point if you so choose. What we initially did was to establish which were the shares now being sold using our identification rules. There were no shares that had been acquired on the same day. There were 500 shares that had been acquired within the previous 9 days. Remember what that simple calculation was? We knew the cost figure, that was specifically given in the question as 5,000. We had to work out the proceeds. We sold 500 out of 3,000 for a total 36, and that was 6,000. So there was your first figure of gain of 1,000. But most of your work is to do with the share pool. Original acquisition indexed through to the next operative event, the acquisition in November 96. Record each acquisition, number of shares, cost of shares, index cost. Always do your re-indexation before then dealing with any further acquisition, any further purchase, or any disposal. That was the 5,000 index cost figure times 0.329. That was the 1645. Add it all in. That meant following that acquisition in November 96, we had 3,000 shares costing £17,000 and with an index cost of 18,645. That index cost rose to 33,934 via the indexation, the re-indexation through to December 17, the last point to which we could apply indexation. We are now selling 2,500 out of 3,000 shares that had originally cost 17,000. So on this proportionate pool basis, something we're used to from, again, the work we did back in chapter 13 for individuals, that's given us a cost of 14,167. We do the same apportionment in terms of the index cost of 33,934. That would appear to give us 28,278. Again, in reality, you then get your revised total for the remaining 500 shares and carry on with that through to a future further acquisition or disposal. But what we needed to know were these numbers. We needed to know what was the cost of the shares sold, what was the index cost. Because now we can use that information to compute the gain on those 2,500 shares. Well, the remaining 2,500 out of the 3,000 shares sold for £36,000 gives you the remaining proceeds of £30,000. The cost figure of 14,167 comes in to now give us our unindexed gain. And our indexation allowance is the difference between that cost of 14,167 and the index cost of 28,278. So 28,278 minus 14,167, that is 14,111, I hope, thus giving us a chargeable gain of 1,722. So what's the total gains made? The 1,000 on the shares acquired in the previous 9 days, plus the 1,722 for the shares sold out of the share pool, a total of 2,722. This exercise here, if it's just an objective testing question, can be easily shortcut by going, we've sold for 30,000, what is the index cost? 28,278. That figure is less than the proceeds, so it will result in a gain. A gain there, as we've seen, of 1,722. You can do it like that. The reason for this proper way of deducting cost and then deducting indexation is because you cannot use indexation to either create a loss there or to increase a loss. So that's why you're supposed to separate it out. But if it is clear that that figure, as it is there of index cost, is less than your proceeds, don't bother with that calculation unless your workings are required. It's section C. If it's section C, show it done in the correct way. If it's section A or B, which it's much more likely to be, then it's simply a disposal and therefore, simply an objective testing question, testing out what's the gain on the disposal. You're either right or wrong with the number that you produce at the end of the exercise. But if in, for example, the corporate tax question in section C, part of it is that the company that you're preparing the corporate tax computation for has disposed of some of its shares in another company, then, and you've got to compute the chargeable gain, then you'd need to set that up properly. Make sure that you know how to properly present, but equally if it's just an objective testing question, where and how to shortcut. Okay, that therefore shows you the rules. You will also recall that other than buying shares as an acquisition from an existing shareholder, what you might do is to acquire shares directly from the company that you've invested in itself, through that company making either a bonus issue or a rights issue. What was the difference? In both issues, you get more shares. You, of course, have to work out how many more shares. I get 1 for 3, 1 for 5, 2 for 5, whatever the ratio may be there. How many shares? If it's a bonus issue, that's just more shares acquired. If we are talking in terms of course, a rights issue, not only do we increase the number of shares we own in our share pool in the number column, we've got the extra issue of shares, be it bonus, be it rights. But if it's a rights issue, then there is also cost involved. Bonus issues, there's no cost. The company simply issues additional shares to you in the form of the bonus issue. In your share pool, that pushes up the number of shares in your number of shares column, but that's it. It doesn't do anything else. There is no cost. A rights issue is just like another acquisition, therefore. It is again another just operative event. So you need to know how many shares and you need to know the cost of those shares. Again, a simple working. What I'd like you to do, therefore, before next time is, and it's not going to be a huge amount of reading, just read that point on bonus issues, and read that point on rights issues, and then next time in class together we will work through the exercises, the examples based upon that. I look forward to seeing you then.